How many times have you heard, don't buy whole life insurance, buy term and invest the difference?
Many times.
Well, what we do at Infinite Wealth is we're not just going to take somebody's word for it. We're going to do the math. So that's what this video is. We're going to compare buy whole life or invest the difference, and we're also going to talk about the infinite banking concept.
Absolutely. And today's video is actually a supplemental video to the podcast that we just released. It's called, Should I Buy Term and Invest the Difference? How one question saved this guy $1 million. And so today, that's what we're going to do. Like Anthony said, we're going to dive into the numbers, and we're going to actually do the math on these two scenarios. So, Anthony, when we get started, if you could, give us a little background on this case here, right? Because a gentleman had given you a call, right? Tell us about that.
Yeah. He had paid his first year's premium, and then he called me. He's like, you know what? I'm doing so well in the stock market. Why should I put money in my life insurance policy? Why don't I just go straight in and invest in the market?
When you got that call, what was your first reaction?
My first reaction is he's missing it, or he's forgotten, because this ain't your mama's whole life insurance.
Nice,
right? We design the policies very different. We design it for the infinite banking concept. And if you haven't heard about it, I would highly encourage you to read Nelson Nash's book, Becoming Your Own Banker, and also check out our podcast where we will discuss that as well. And that's the Infinite Wealth podcast. But the thing with infinite banking and the way we design the policy and the way we teach people to use it, it's not just put the money in there and sit on it. It's not. That's why we say this isn't an either or. Mm-hmm. We're not saying, oh, put your money in the market or life insurance or real estate or your business, right? The way we design this policy is it's a safe place to store cash that's going to be accessible. It grows at a decent rate of return, and it's also protected from creditors.
Awesome. Great. Let's dive in. Let's look at some of these numbers. What do you think?
Let's do it.
Awesome. So here's what the guy was thinking, right, is he has a policy. Anthony, how about you take us through a couple of these numbers? What if he was, maybe look at the premiums that he was paying in and then the cash value that he'd have at the end of 30 years?
Well, in this situation, his premiums were $20,000 a year. He put in a little bit more, I think, in year one. But at the end of the day, we ran this for 30 years, and at that point, he'd be 65. But he'd have about $1.5 million inside his whole life policy.
All right. Pretty good.
Mm-hmm.
And so I'm going to guess what was kind of going through this guy's head. He said where was he going to put the money? Did you say the market?
Yeah.
Yeah. Mm-hmm. And how was he doing investing in the market?
Well, he told me that he earns 10% every year that he's been investing.
Okay. So I can imagine that he's probably just assuming he's going to earn 10% every year moving forward. You want to hand me that?
Mm-hmm.
Let's look at that number, right?
So I think what his first reaction is, hey, so we're starting with $31,000, and if I put in $20,000 a year, and I earn 10% every single year after fees and so forth, he's thinking, hey, I could have $4 million.
Yeah.
And I don't know about you, but I'd rather have $4 million than $1.5 million.
Absolutely. If that's the case, I'm in. Sign me up. I'm doing the same thing.
But here's the problem with that math. He's got to buy term insurance, right? He needs to protect his family, but also he's got to pay his other partner, the IRS. So what we did here, you're going to see that we have the beginning balance of $31,000. He's putting in $20,000 a year. So he said he could earn 10%. Perfect. So that's what we are calculating. But remember, he's got to pay taxes on that. So in his example, we use 22%. Okay. He's also has to pay term insurance. And if the best way to lock that in is to do a 30-year term. So that way he knows his family's protected until for the next 30 years. So when we calculated the expenses from the IRS and the term insurance, he'd have $2 million.
So not the 4 that he assumed, right? But actually $2 million.
You're right. What I think is interesting, and I think this is where most people get lost, is they're thinking they're going to get that $4 million, but they really have half of that. Now imagine if you end up with half of the money that you think you would be. You're not going to be a happy camper when you're 65.
I'm not going to be a happy camper, but still, given that scenario, if you look at these two numbers, he's comparing 1.4, 1.5 million in his policy to walking away with 2.1 million. In that scenario, I'd still take option number 2 because it's more money, right? All right, so now let's take a look at what it looks like or let me ask you this, what'd you do in the next scenario?
Okay, so, because remember, like I alluded to before, is that you can use a policy to invest, that this is an and asset. Again, we're following the infinite banking concept. If that's something you haven't heard of, we did a video called IBC Explained in 12 Minutes. So that's going to be in the notes. But so I'm gonna walk you through it. Now, what we're doing, again, we have the beginning balance, and I do want to say, like, you can see we don't have any growth in here, but I wanted to make sure that I followed everything in particular. So what I use numbers directly off the illustration, and those numbers already included that year's growth in premium. So, but you can also see we are putting the 20,000 in here, right? So, but we have the earnings. So what he's doing is he's leveraging his policy. Now, this is key. He's not taking the money from his policy. He's taking a loan against that policy. So what's happening is, since he didn't use his money, he's using the insurance company's money. He's going to have to pay them. He's going to have to pay them interest. Okay, where a lot of people get stuck right there. Well, wait a minute. I got to pay to borrow my own money. You're not. You're not borrowing your money. You're borrowing the insurance company's money. And Cameron, what's happening to their money?
Your money is continuing to grow. It just sits there and continually compounds every single year.
So that's the key. So, but really, to me, the key is the bottom line. So as you're going to see, we will transition to the end of the line, but I wanted to explain how we came up with these numbers. So he told me he could earn 10%, but that 10% is going to be taxable. Okay. I'm sorry. This is the interest. There is going to be an interest expense. So we are subtracting that from this account. But what's unique about this is you use a policy loan for an investment purpose. That interest you pay is tax deductible. So you're going to see what we're doing when we're calculating the actual interest. We're subtracting the interest from the earnings, and that's what he's paying tax on. So we're actually paying less tax here. Then we just complete the process. You know, what we've done here is we've calculated the year-to-year growth, and so he is adding that, and then we're just continuing this process. But as we go all the way down, here's what's interesting. Inside the investment account, we're going to have about $3 million.
Okay.
Right? But we use a policy loan, so we do need to pay that back. So that policy loan was about 1.3 million, around 1.4. So the bottom line, he's left with about 1.5 million in this investment account. And he still has the 1.5 million inside his policy.
Okay. So let's review. So the numbers that you just showed us were he's got $3 million if he takes his max loan from his policy, invests in the same thing that he was going to do otherwise, or if he just pays the $20,000 and just buys the investment, he ends up with $2 million. Is that right?
Correct.
So there's a difference of $1 million.
Or I also say about 50%, or in this case, I guess it's 43%.
Okay. So we've got 43% or $1 million more, Anthony. That doesn't make sense to me. Why is there such a big discrepancy between these two scenarios?
This is why this works. And again, because it's the power of compound interest. Your policy is continuing to grow even though you are using it. What you're going to see here on the buy term invested difference, the most investments he can buy each year is going to be $20,000. Okay. But if you look inside the buy whole life invested cash value, you're going to see here in year 3, he can invest $20,000. He has to invest $17,000. And, you know, there is a slow start in whole life insurance, and we have some other content on how and why. But what you're going to see is now in year 4, he can invest with $21,000, not $20,000. And again, the way these policies, the way that we design them, they're designed to get better and better and better each year. So if you look in year 10, the growth is $30,000. So now he's buying $30,000 of investment versus only $20,000. And as you can see, in year 15, just 5 years more, he can invest $40,000 that year, when over on buy term invested difference, he can only buy 20. He's limited to the 20. So now he's investing twice as much as he is with buy whole life and invest the interest. And I won't excite you by going down every single year, but as you can see, the growth is growing. And like right here, we have $80,000. So here we can only invest 20, but with our strategy, he can invest $81,000.
So that right there is pretty powerful, right? About how we came up with $1 million difference. Anthony, here's a question for you: does he have to be investing in an investment account?
No.
Can it be something else?
It can be whatever. I mean, personally, I'm not a big fan of the stock market, so I don't invest in things that I don't know. But this could be real estate. This could be lending. I mean, I've used this for, like Nelson talks about, there's infinite banking concept. There's infinite ways to use it. We've used it to pay for our kids' college, to finance cars. We've paid off debt. We've bought real estate. We've invested in our business. We've started new businesses. We've loaned money. I mean, you name it. We have used this for whatever the financing needs of our family.
Now, if you could scroll down a little bit. So now let's look at this a little. Well, you know what we're going to do is let's take this into part 2. What do you think? My question would be, what you did is you just took us through this scenario where we're buying term, investing the difference. Is there anything that we could do in addition to this to make this scenario even better?
Yes, there are many things which we're going to go to in our next video. Yeah. And then we're gonna geek out and do a couple of different things that are going to make this look even better.
Awesome.
And to me, the bottom line is, I'd rather have 3 million than 2 million.
Absolutely.
Right. And what we would encourage you to do is, whenever you hear a statement, whether it's buy term, invest difference, or whatever it is, look into it. And I think what hopefully we've showed is that when you do the math, there may be some things that people are telling you that just ain't so.
Great. So in part 2 of this series, what we're going to look at is we're going to look at ways that we can improve this scenario. And then also what we're going to do is we're going to dive into, now that we've got $3 million of income or $3 million of assets, what do we do with it? How do we turn that into income in retirement? And we'll look at some different options. And so this is going to be a really good video, and I think you guys are going to enjoy it. So make sure you stick around and check out the second part.
And I'd also check out the Infinite Wealth podcast to learn more ways about infinite banking, but also more ways to create passive income. Go make it a fantastic day.
Take care.